Welcome to today's episode of Buck Talk. Here's a little sneak preview of what we'll be doing. And bang, there's the value. Hold. That is okay. So I didn't run these numbers ahead of time, but that is awfully close to the all-time high. Today, I'm going to be doing something very special. I'm going to be trying to explain why the stock market is down. Now that's going to sound ridiculous. Obviously, we know why the stock market is down, coronavirus. But a lot of people are confused. They're saying to themselves, hey, why is the S&P 500 only down about 10% for the year and only down about 13 or 14% from the very top where it was in February when this seems like it's so bad? And I'm going to make a bunch of oversimplifications, and this is really just an example of one way that you can value the stock market. But we're going to take a look at why it might be reasonable or what the market might be assuming. And what does it mean if the market's down 10%? How bad does that mean that the market thinks that this whole situation is going to end up being? How long is it going to last? How long is it going to impact earnings and profits? So we'll take a look at that, and we're going to model the whole thing in Excel. Before we get into the details, none of this is investment advice. I'm not your advisor. But if you want more videos like this, be sure to like and subscribe. Now, the only things that I put in here ahead of time are just to save us a little bit of time. I punched in a couple of, I thought, key S&P 500 values. And again, I'm going to use the S&P 500 here, but you could look at any index you want. You'll get different assumptions, different outcomes, different things to think about depending on what you use, what you look at. But S&P 500 biggest U.S. firms. So on 12/31, at the end of the year, the value of the S&P 500 was just over 3,200. At its peak on February 19th, the value was almost 3,400. At the lowest value we've seen so far, the value was about 2,240. That was March 23rd. And as of the last trading day, the market was at 29.29. So the current difference from the end of the year, we're down about 9.3%, and the difference from 2019, we're down about 13.5%. So where did I get that data? I'll show you just in case you ever want to get it yourself. You just go to Yahoo Finance, and of course you can look at a chart. And if you want, you can try to find whatever data you want by scrolling on the chart. But you can just go to historic data, and you can even download any of it if you want it. It's very, very convenient. And we're going to build what's called a dividend discount model. And this is an academic way to model the value of a company. And I'm going to apply it to the whole S&P 500. And I'm going to use a couple of shortcuts and a couple of assumptions that I think are smart. It's not going to be exactly the way you learn it in a corporate finance class, but it's going to be pretty darn close. So first thing is we got to decide how many years we want to run this thing for. And I'm just going to go down until I get to 100. That's my plan. I'm going to assume that this valuation model values these companies for 100 years. I think that's very reasonable. Basically, what the dividend discount model says is that the value of a company is determined by the expected future value, or the present value of all future dividends. So if you add up all the money that a shareholder is going to get for the rest of the time they own that stock, that's the value of the company. It makes a lot of sense. You got to think about it a lot to understand it, but basically a company is worth what it can create for its owner. And if it's returning it via dividends, then that makes a lot of sense. Companies where they're buying back shares, they start to throw a wrench in this. So, well, we'll look at that, but we're going to assume dividend discount model for now. We'll need a couple things to punch in here, but the first one is the dividend. So again, I'll show you where we're going to go. Dividend yield, and let's use the yield. I'm on Y charts here. Let's use the yield from the end of the year. So the yield was 1.8%. 1.8%. And we know what the value at the end of the year was. Okay, so S&P 500 was paying a dividend of about 58 bucks. And that was looking backwards. Dividend discount model is supposed to be looking forwards for the next year's, whatever. It shouldn't really make a difference to us. This is just for illustration. And then we have to make an estimate of growth rate of dividend. And this is going to change the way that the model looks. I'm going to assume 3%. We can look at what it would look like if it was different numbers. You can look at it yourself. But 3% seems like a reasonable dividend growth rate to me. And then you have to have something, I'm going to call it the discount rate or cost of capital. So this is the rate that you should be discounting future cash flows at. So having $100, or in our case, $58 today is worth more than having $58 or $100 a year from now. So we want to say, okay, if the dividend has grown, but it's the future, we got to discount that back. So this number, we're actually going to end up reverse engineering, but let's just start with something like 4%. Okay, so these are the dividends. These are discounted dividends. Spread this all out a little bit. And this is going to be easy, so we just want this to grow by this. And then we want it, oh, not that far. We want it to go down all the way. You can see 100 years of dividends growing at 3% a year. And then remember, we want to discount that. I'm even going to discount the first year here. So to discount it, we're going to do this times 1 minus the discount rate. And we're going to do that for however many years there have been. So you can see, even though the dividend is going up by 3%, because we're discounting it by 4% a year, the real value is actually going down. So that's kind of a key thing. And most of the academic models, they say just model it as if these things get paid forever. I don't know if it's realistic to assume that somebody buying a stock is going to care what the dividend's going to look like more than 100 years from now. It doesn't really matter. So this is kind of the cool part. We can say value of S&P 500 from model, and all we have to do is do the sum of all of these. And bang, there's the value. Hold. That is okay. So I didn't run these numbers ahead of time, but that is awfully close to the all-time high. So if we're using the dividend discount model and the growth rate of the dividend was 3% and the discount rate or the cost of capital is 4%, then you would value the S&P 500 at 3370. So really close to where we were by February. So that's pretty wild. We can figure out exactly what these would have to be for it to equal a different one of these numbers. So let's figure out what would the discount rate have to be to make this the value that it was at the end of 2019. Let's take a look at that. So for this, we can use goal seek. That's Alt AWG. We'll take you to goal seek real fast. So we want this to equal, and again, the value on 1231 is just right there, 3230, 78. And we're going to do it by changing the discount rate. Okay, it didn't change much, but it's no longer a whole percent. Okay, so moved it to 4.10. This stayed at 3, by the way. We didn't change it. So now we have our model built, and this is where we can start playing with things a little bit. We can say, what if dividends got wiped out? for 1 year, for 2 years, for 3 years? How much of an effect would that have on things? And before we look at that, I want to give you a sense for what dividends look like on the scope of the company. So the dividends, again, 1.8%. We have that written down in our spreadsheet, so we don't have to find it again. The earnings for the same amount of time were 4.32. So let's be sure to put that in our model. So earnings 4.32%. So the dividend represents 2.4 years worth of earnings. Okay, so that's good. We'll keep that in mind. That's important to know. So what if we start wiping out these dividends? You can see it changed the value of our model, right? How many do we have to wipe out to get to the current value? Let's test. Okay, 6 years. Just about 6 years of earnings, of dividends, getting wiped out, ends up with the value of the S&P 500 about where it is right now. Now remember, the dividends are just a portion of the earnings, and we could just do the calculation the other way. So we could do equals N4 minus divided by N14. So only about 41% of the earnings are getting paid out as dividends. But if the entire earnings were getting wiped out, we'd be wiping out 2.4 years of dividends for each one. So you do equals 6 divided by 2.4. If 2.5 years of earnings were zero, so if every company in the S&P 500 has earnings wiped out for 2.5 years, that's the kind of decline that we would expect to see. So I think people saying the market's underreacting to what seems to be going on, based on this model, 2.5 years of profits or 6 years of dividends getting wiped out, I'm not sure I agree. I mean, that seems like some pretty significant value destruction there. Sort of fits. I mean, it's really interesting to start thinking about how many zeros you have to put in here to get to this 2237. I mean, that's, keep going. Wow. Yeah. 20 years worth of dividends, or let's see, what is that? Equals 20 divided by, or 8 years of earnings would have to be destroyed to get to where the market was on March 23rd at the very bottom. So obviously this isn't the only way to value things. This isn't the right way to value things, but it is a way to value things. And I think it's a very reasonable, principled way to value things. And you can see under those assumptions, the stock market isn't down that much, but it is pricing in a pretty bad event. 10% is a lot. The stock market fluctuates for no reason at all, but when it moves for a reason, 10% is a lot for it to move. So I hope that was educational. I hope you feel like you learned something and maybe even play around with it a little bit yourself. Be sure to like and subscribe.